What if I told you that the single worst one-day stock market crash in modern history didn't happen during the Great Depression, didn't happen in 2008, and didn't happen during the pandemic? What if I told you that in just one day in 1987, Wall Street lost over 22% of its value, wiping out trillions of dollars of wealth, an impact so severe that entire nations were shaken to their core? And the strangest part? Almost nobody saw it coming. There was no war that broke out, no oil embargo, no terrorist attack. Just a Monday morning in October when the global financial system simply collapsed on itself. This is the story of Black Monday, October 19th, 1987, the day markets fell out of the sky, and the lessons it still screams at us today. To understand Black Monday, we need to rewind to the 1980s, a decade of power suits, big hair, and an economy riding the wave of newfound optimism. Ronald Reagan was president. Reaganomics had promised a future of lower taxes, deregulation, and unleashed corporate growth. Wall Street traders were getting rich off a booming stock market, fueled by speculation and confidence that the good times would last forever. Technology was creeping into the system in a new way. For the first time, computers were being used to automate trading. What started as an innovation to make markets faster and more efficient would soon become a ticking time bomb. And in the background, something subtle but powerful was brewing. The US dollar was falling. Interest rates were shifting. Geopolitical tensions were rising. Yet few paid attention. The party was too loud, the champagne too sweet. But history teaches us one thing. Financial euphoria is usually followed by financial disaster. And on October 19, 1987, that disaster arrived. The crash didn't come out of nowhere. The seeds had been planted years earlier. From 1982 to 1987, the stock market had been on an incredible bull run. The Dow Jones Industrial Average had tripled in just 5 years. Investors believed the new age of prosperity had no ceiling. Wall Street became a playground for speculators. Hedge funds and traders were experimenting with new strategies like portfolio insurance, a supposedly safe system that would automatically sell stocks if the market started to drop. Sounds smart, right? In theory, it was. In reality, it set up a deadly feedback loop. Interest rates and the dollar problem. By 1987, inflation fears were creeping back in. The Federal Reserve raised interest rates to cool things down. At the same time, international tensions about currency exchange rates, especially between the US and Japan, added instability. Investors started to worry. And in markets, fear spreads faster than logic. This was the first era of computerized trading. Orders that used to take minutes could now be executed in seconds. On a normal day, this was a miracle. On a bad day, it was gasoline on a fire. As one trader later put it, we created the tools to speed up the market, but nobody realized how fast it could spin out of control. The conditions were set. All it needed was a spark. The summer of 1987 looked golden on the surface. The Dow was at record highs, corporate profits were strong. But beneath, cracks were forming. In August, interest rates ticked up again, making borrowing more expensive. In September, whispers of trade tensions and budget deficits spread. By early October, markets had slipped from their highs. Still, no one expected catastrophe. Investors shrugged it off as normal volatility. After all, the computer models promised that portfolio insurance would keep them safe. Then came Friday, October 16th. The Dow fell 4.6% in one day. Bad, but survivable. Traders went home for the weekend nervous but not panicked. On Monday morning, October 19th, the market opened and everything unraveled. The breaking point, October 19th, 1987, what happened next was chaos in slow motion and then chaos at lightning speed. The market opened sharply lower. Selling pressure was everywhere. Investors rushed to the exits. But here's where the deadly flaw of portfolio insurance showed itself. The more the market dropped, the more the computers told funds to sell. And the more they sold, the faster the market collapsed. It wasn't just human panic anymore. It was machines feeding the fire. By mid-morning, the Dow was down 200 points, a huge number at the time. By noon, it was clear something unprecedented was happening. Traders on the floor described it as watching an airplane fall out of the sky. Phones were ringing nonstop, orders were flooding in, and no one could keep up. By the closing bell, the Dow had fallen 508 points, a 22.6% crash in a single day. For perspective, in today's terms, that would be like the Dow losing 7,000 points in one day. Trillions of dollars evaporated. Retirement savings were wiped out. Corporations lost decades of value in hours. The impossible had happened. The crash didn't just stay in New York. It spread like a virus across the globe. London, the FTSE 100 dropped 26% in 2 days. Hong Kong, the market fell so fast it had to close for a week. Australia, Canada, Europe, everywhere, markets plunged. Ordinary people who had trusted Wall Street suddenly saw their wealth cut in half. Pensions trembled. Small businesses lost financing. Governments scrambled. And for the first time, leaders had to confront a terrifying reality. The world's financial system could collapse in a single day without warning. In the aftermath, policymakers and economists were left stunned. The Federal Reserve, under Alan Greenspan, promised to serve as a source of liquidity to support the economic and financial system. In plain English, the Fed would pump money into the system to stop the bleeding. Markets eventually stabilized. But the structural flaws remained. Portfolio insurance was quietly abandoned. Regulators introduced circuit breakers to pause trading during crashes. But the deeper problem, the combination of overconfidence, complexity, and blind faith in technology, was never truly solved. And that's why Black Monday still matters today. Modern parallels, patterns that repeat. Here is the shocking part. The same mistakes that caused Black Monday keep showing up again and again. 2000 dot-com bubble. Overconfidence in tech stocks. Collapse. 2008. Financial crisis. Blind faith in complex mortgage derivatives. Collapse. 2020. Pandemic crash. Panic selling amplified by automated trading. Collapse, then rescue. And even today, algorithms control the majority of trading on Wall Street. High-frequency trading firms can buy and sell in microseconds. A glitch, a rumor, or a sudden panic could set off another chain reaction. Consider this. On May 6, 2010, a flash crash sent the Dow plunging nearly 1,000 points in minutes, only to recover just as quickly. That was a glimpse of how fragile the system still is. Or look at 2022 to 2023, when inflation and rising rates once again pushed markets to the edge. Many analysts quietly admitted, we're only one bad day away from another Black Monday. History doesn't repeat itself, but it rhymes. 3 takeaways, lessons from the crash. So what can we actually learn from Black Monday? Three things stand out. 1. Complexity creates fragility. The more complicated we make financial systems, portfolio insurance then, algorithmic trading, now the more hidden risks we build in. 2. Confidence is a bubble. Markets rise on trust, but when that trust cracks, the fall is violent. The biggest crashes don't happen when people expect bad news. They happen when everyone assumes nothing can go wrong. 3. Crashes are inevitable, but they're survivable. Black Monday didn't destroy the global economy. It was devastating, but the world kept going. The true danger is not the crash itself. It's ignoring the lessons afterward. Black Monday wasn't just a freak accident. It was a warning shot, a reminder that markets are human systems dressed up in technology, and humans are flawed. The next Black Monday could come from algorithms, geopolitical shocks, or something we can't even imagine yet. But the question is, will we be ready this time? Or will we repeat the cycle of forgetting, overconfidence, and collapse? If you want to understand the past to protect your future, keep watching. Because history doesn't just live in textbooks, it's repeating all around us. And if you found this story valuable, consider subscribing to the channel. That way, you won't miss the next deep dive into the financial events shaping our world.